Did you listen to me in mid-October when I rated Alibaba as a buy? Implied share price of about $134 a share compared to the current price of about 102. That's a 31% discount, which is definitely a buy. Well, since that recommendation, Alibaba has crushed the market by 4.5x. Don't worry if you missed out, because I just spent the last week updating my full fundamental analysis on Alibaba based on their recently reported March 2025 results. Trading at $115 per share, I have a buy rating on Alibaba stock. In my research, I discovered 6 things that got me really excited and 6 red flags to watch out for with Alibaba. So what did I discover? What's my value for Alibaba stock? And what's an ideal entry point should you decide to become an Alibaba shareholder? I'm Ken Freeman. I have 20 years of Wall Street experience in investment banking and hedge funds, and I train analysts at the top banks on Wall Street. In this video, I will cover Alibaba's recent results and what everyone is missing, what I think about Alibaba stock and what my analysis uncovered, what Wall Street's smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. If you're enjoying this, please smash that like button. Alibaba recently reported their fiscal year 2024 results, and although they missed some expectations, there was a lot to be excited about.
Show me the money. Show me the money.
Let's cover the red flags first. In the last quarter, free cash flow dropped 76% year over year. While this was due to the increase in cloud infrastructure expenditure, execution is critical.
Free cash flow this quarter decreased 76% to RMB 3.7 billion, which was mainly attributed to the increase in our cloud infrastructure expenditure.
Revenues were down because of a decrease in domestic logistics services. The long-promised IPO was abandoned, resulting in EBITDA moving up. Investors need some clarity here.
This is like in last century. We will improve it. Logistics is important. Payment is important. And internet is important.
Alibaba International Digital Commerce lost $2.1 billion in EBITDA last year, nearly double the prior year's loss. Scaling cross-border storefronts is proving difficult. Overseas retail is not a profitable strategy today.
AIDC continued to focus on enhancing operating and investment efficiency, leading to a narrowed losses this quarter. In particular, the unit economics of the AliExpress's choice business improved on a sequential basis. AIDC has a diverse geographical presence.
While revenue grew due to order growth and marketing services, losses continued. Food delivery is a difficult business and profitability is still not seen.
Revenue from local service group grew 10%, driven by the combined order growth of both AMAP and Ele.me, as well as revenue growth from marketing services, while its adjusted EBITDA loss continued to narrow year over year as scale increased and unit economics improved due to operating efficiency.
Keeping users engaged is getting pricier. Sales and marketing expense jumped 26% year over year. Margins are getting squeezed just to keep traffic flowing. Recently, the European Commission flagged AliExpress for Digital Service Act breaches, threatening fines up to 6% of global turnover. This illustrates how cross-border regulation can squeeze margins and distract management.
What's the good part?
Here's what got me really excited. Cloud Intelligence Group revenue grew 18% year over year, driven by a burst of public cloud demand. Even better, AI-related product revenue kept triple-digit growth for the 7th straight quarter, proving that the flywheel is spinning.
Driven by robust and growing AI demand, Alibaba Cloud's revenue growth accelerated to 18% this quarter, with revenue excluding Alibaba consolidated subsidiaries increasing 17% year over year.
Customer management revenue at Taobao and Tmall jumped 12% year over year to $9.8 billion as higher take rates and smarter ad tools kicked in. The main cash engine is clearly back in growth mode.
We saw a substantial increase in CMR growth, which grew 12% year over year, primarily driven by the improvement of take rate. Our take rate benefited from the impact of the software service fee and the increasing penetration of 全站推. Merchants benefit
During fiscal year 2025, Alibaba repurchased $11.9 billion of shares, thereby achieving a 5.1% net reduction in outstanding shares. And the board of directors approved the distribution of annual and special dividends totaling $4.6 billion.
In total, we are distributing $2 per ADS in cash dividends this year, amounting to $4.6 billion. Combined with the $11.9 billion in share repurchases, we have returned a total of $16.5 billion to our shareholders for this fiscal year.
Shareholders are finally being rewarded for their belief in the company.
Oh, good news, buddy, good news.
The premium 88 VIP tier grew double digits year over year, blowing past 50 million members. A bigger pool of high-value customers means stickier revenue and stronger pricing power.
Taobao and Tmall Group saw stronger momentum in new user growth, and 88 VIP members surpassed 50 million. This quarter, TTG customer management revenue rose 12% year over year, while adjusted EBITDA increased by 8%. We continue to invest in improving the operating environment for merchants, increasing our support for those offering high-quality products and services.
The 2025 Gartner Innovation Guide named Alibaba Cloud the only Chinese provider tagged an emerging leader across all 4 generative AI submarkets. Third-party validation like this fuels enterprise adoption and pricing leverage.
Cool.
This is what everyone is missing. Ray Dalio and Bridgewater Associates, the world's largest hedge fund, increased their stake in Alibaba by over 33x, going from $22 to $727 million. Back in February, when Alibaba was near its 52-week high, Ray Cohen, the CEO of GameStop, increased his personal stake to $1 billion, calling Alibaba undervalued and urging faster share buybacks to unlock long-term value.
A lot of money.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's 3 financial statements. Would you buy a house without knowing the size, location, dimensions, or condition? That is what you are doing when you buy a stock without understanding the 3 financial statements. If you want to see how I teach the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen.
Roger that.
The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. With almost $58 billion of cash and short-term investments, Alibaba has plenty of dry powder to invest in the cloud and AI to drive long-term growth. Equity investments jumped from $67 billion to $85.5 billion. This is because Alibaba's investment in Ant Group jumped significantly in value. Alibaba owns 33% of Ant Group, which provides digital payment services, kind of like a PayPal. Debt increased last year by more than $8 billion to $31.8 billion. Normally, this might pose a concern, but cash exceeds debt by almost $26 billion, providing plenty of cushion. S&P Global affirmed Alibaba at a strong investment-grade credit rating of A+ with a stable outlook. Retained earnings increased over $6 billion to almost $89 billion, and this is despite paying a dividend of $4 billion. This is due to the strong net income the company is generating. We're going to see this next in the income statement. So what's the takeaway? Cash is abundant, equity investments are growing in value, debt is under control, and retained earnings are increasing. All things that investors love to see. The income statement shows us if a company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Over the last 3 years, revenues have only increased 2%. This is mainly due to the post-COVID reset and slow economic growth. Now, despite dismal growth, Alibaba did an amazing job managing costs. While gross margin has only seen a slight recovery since 2021, operating margin has seen a relative increase of almost 72%, going from 8.2 to 14.1%. Maintaining conservative cost management will really boost margins as the company grows moving forward. Net income is the star of the show here. While revenue has grown 2% over the last 3 years, net income has grown an eye-popping 134%. If that isn't impressive enough, net margin has increased more than 2.2x, going from 5.5 to 12.6%. Remember, revenue is what you make, net income is what you keep. And with net income increasing faster than revenues, this will positively impact cash flows moving forward. We're going to see this next in the cash flow statement. So, what's the takeaway? Increasing revenues, conservative cost management, and expanding margins all are major positives that bode well for investors in Alibaba stock. The cash flow statement tells us where the cash is generated by the company, and there are three buckets: operating, which is the cash the company generates internally; investing, which is the cash demanded for long-term growth; financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. While free cash flow was nearly cut in half last year, there is a good reason for it. The decrease in free cash flow was mainly attributed to the increase in cloud infrastructure expenditure. Alibaba has decided not to just deploy its cash into cloud infrastructure. They also decided to invest 17.4 billion of cash into treasury investments. We have seen this in the past with the Mag 7. Since they have so much cash, they invest it to get a return while still ensuring that it's liquid. Patient shareholders who held on through the downturn of 2021 were finally rewarded. Share repurchases and dividends combined for nearly $16 billion returned to shareholders last year. So what's the takeaway? Alibaba is investing heavily in AI and cloud infrastructure while investing excess cash into safe liquid investments and returning billions of cash to shareholders. Things are headed in the right direction. So what do I think about Alibaba stock and what should you do? I'll get into that, but first, let's go through my valuation.
All right, let's see it.
On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the three financial statements, we can take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to build financial models like we do on Wall Street, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items that we projected from the three financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of $351.4 billion. We divide by the current shares outstanding, we get an implied share price of about $147. Compared to the current share price of $115, that's a 27.6% discount, which is a solid buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides a margin of safety. I'll give you my thoughts on how to play Alibaba stock later in the video. So what does Wall Street have to say about Alibaba stock? Let's cover that next. Analysts broadly believe Alibaba's leading position in AI-powered cloud services, combined with a recovering domestic e-commerce market, will drive sustainable revenue and margin expansion over the next 12 to 18 months.
Sounds good to me.
Mizuho has an outperform rating with a target of 160 reduced from 170. They acknowledge regulatory overhang but see a compelling long-term AI and cloud investment case. Loop Capital has a buy rating with a target of 176. They are bullish on the company's accelerating e-commerce recovery and sustained AI-driven cloud momentum. Morgan Stanley has an overweight rating with a target of 180. They expect robust free cash flow recovery as cloud capex normalizes and core retail markets stabilize. CapIQ gives me a sense of how other analysts on Wall Street view the company. Alibaba has multiple share listings on different exchanges. Our focus is on the analysts that cover the ADS on the New York Stock Exchange. 24 analysts cover Alibaba on Wall Street. The target price is from a low of 97, which is a 16% decrease, to a high of 171, which is a 48% increase. The median is 150, which is a 30% increase. The overall rating on a scale of 1 to 5 is 1.28, which is a buy rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I currently do not hold a position in Alibaba, but this analysis might be changing that. If you decide to buy Alibaba, I'll tell you exactly how to build your position, which I'll reveal shortly. The following insights are what make me very bullish. The alliance lets enterprises run SAP's platform and AI workloads natively on Alibaba Cloud, combining SAP's business backbone with Alibaba's scalable, region-optimized infrastructure. Alibaba is pumping $100 million annually into Southeast Asia's affiliate program to turbocharge Lazada's market share, setting the stage for outsized e-commerce growth in the fastest growing region.
Some companies still know how business is done.
Goldman Sachs named Alibaba among China's top 10 AI and digital transformation leaders, forecasting about 13% annual earnings growth over the next 2 years.
Ambitious.
Alibaba hit a 52-week high of 148.43 in mid-March 2025, and it's down 23% since then. My model shows a value of $147, which is a 28% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%, so Alibaba is a buy at current levels. And if you decide to add it to your portfolio, this is what you should do. Decide how much capital you want to allocate to the position. I typically choose 10% as my max, but start small and build over time. Utilize limit buy orders so you're not chasing the stock. Break your purchases into pieces so that you dollar cost average into the position. Alibaba is poised to take advantage of the cloud AI growth cycle in Asia, and I can't wait to see them execute their plans.
For the best, I hope.
If you like this and want to see another in-depth stock valuation, check out my Intel video here or my Super Micro video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.